Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through the Noise podcast. The closely watched June CPI data saw a downside surprise as price pressures abated further. Headline prices contracted 0.1% month-on-month, while core inflation slowed to 0.1% month-on-month on the back of decelerating shelter inflation. In addition, June non-farm payrolls report pointed to a loosening labor market. One would ask, how do these data translate to the Fed policy and the financial markets? To answer this, I've invited Fook Hien, our senior investment strategist here at the CIO office. Hello, Fook Hien. Going back to the question I asked in the intro, what are the implications of the CPI data and the payroll data on Fed policy and the US equity markets?
Thanks, Dong. Yeah, we believe this is drawing the Fed closer to its first rate cut, encouraged by the cooling job market and slowing inflation. Fed Chair Powell was also signaling this in his Congress testimony this week as he highlighted the risk of keeping rates too high. The markets have cheered the latest turn of events as it confirms the soft landing narrative for the economy, with the Fed expected to come to the rescue as growth slows down. However, there are risks to chasing the US-led equity rally in the near term, with investor positioning in the US technology sector looking increasingly crowded. And this raises the risk of a near-term reversal. To be clear, we still like US equities over a 6 to 12-month period, but instead of adding now, we would wait for confirmation from Q2 corporate earnings. The consensus expects S&P 500 index earnings to grow by 10.1% year-on-year in Q2, led by the communication services, healthcare, and technology sectors. The immediate focus will be on bank earnings, especially the health of the loan books, with credit card and auto loan delinquencies rising, and also the commercial real estate books of the regional lenders. So corporate earnings guidance for the second half of the year is also key, as consensus expects the US earnings to broaden out to sectors other than technology and communication services.
Well, let's shift across the Atlantic to the Euro area. The French election concluded last Sunday with surprise gains by the left wings. Are there opportunities emerging in the Euro area equities from the outcome?
Yeah, political uncertainties in France over the past few weeks, they have triggered a massive sell-off in the equity market there. The benchmark CAC 40 index, it dropped around 8% from its highest closing level since May. However, fading political headwinds after the elections are likely to lift Euro area equities in the near term, given the outcome of a hung parliament with the right wing failing to get a majority. We expect the major stocks of the Euro area equities to withstand regional political events, given their diversified and international revenue base. Now, over 50% of revenue generated from companies there comes from outside the Euro area and the UK. Another support is that potential interest rate cuts by the ECB in the second half are likely to boost market sentiment. Overall, we retain a neutral stance on Euro area equities over 6 to 12 months. However, we see a potential catch-up in the near term as the relative valuations of Euro area versus US equities have fallen sharply since French President Macron called for a snap election in mid-June. The Euro area equities are trading at a discount of 42% to US equities, significantly below their long-term average. On a sectoral view, we favor the technology and healthcare sectors to benefit from surging AI-related demand and healthcare spending.
Moving away from Euro area to China, quite a bit of policy changes recently, and of course a key event to watch next week. On the former, what are the implications for China US dollar bonds, and the CNH, right, after the recent changes to the PBOC monetary policy framework?
Yeah, on the 1st of July, after the 10-year China government bond yield hit a historical low of 2.2%, the PBOC announced it would borrow government bonds from primary market dealers to sell in public markets as a new means to control the yield curve. Subsequently, the PBOC, they introduced overnight repo and reverse repo rates in its short-term policy tools. These measures they led to a rise in both short-term and long-term yields due to increased fears of liquidity tightening operations and yield curve control. Overall, we see the recent surge in China onshore yields as temporary. The demand for longer-term bonds remains strong, and we believe the new repo rates are aimed at enhancing the availability of short-term monetary tools rather than liquidity tightening. Meanwhile, we retain our tactical buy recommendation on the offshore China US dollar bonds, as the interest rate differential between offshore and onshore rates will likely continue to attract onshore investors. For the CNH, the focus shifts to the third plenum next week, especially policies to support the property market and consumer spending. The USD to CNH is likely to trade in an ascending channel, moving towards a 7.31 over the next few weeks.
Since you touched on the third plenum, as you mentioned, it's going to start next week. What are you expecting at the plenum, and what are the implications for the Chinese equity?
Yeah, it'll be starting on the 15th of July, and the plenum is about advancing China-style modernization via deepening reforms. The official remarks leading up to the formal session, they indicate party leaders will likely prioritize advancing already introduced reforms, but in a concerted manner to maximize benefits for the entire population. We expect the plenum to 1. Reiterate the party's support for private sector expansion and a stronger state sector, with a decisive role for the market in resource allocation. 2. To take steps to remove cross-region barriers and encourage innovation and green transition and improve income distribution. And thirdly, to attach greater importance to security, addressing risk in the housing and financial sectors, and increasing the resilience of the supply chain. The market will likely pay close attention to potential fiscal and tax reforms. Our technical model is now indicating continued downward pressure for Chinese equities. However, there are pockets of opportunities, such as your non-financial, high-dividend yielding, state-owned enterprises. The technology hardware subsector is also attractive given the replacement cycle of AI-enabled personal computers and smartphones.
Plenty to digest here. The key takeaways for me are, firstly, the Fed rate cuts drew closer on the slowing US economy. Secondly, US equity rally looks increasingly stretched, and we wouldn't chase it at this stage. Third, a near-term catch-up of the euro area stock is likely. And lastly, within China US dollar bonds are attractive on strong onshore demand, while there are pockets of opportunities in Chinese equity, such as the non-financial high-dividend yield SOEs. Thank you, Fook Hien, for your insightful sharing, and thank you all for tuning in to this week's podcast. Have a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.